You've heard of banks. You trust them, or at least you understand them. You deposit money, they lend it out, regulators watch over them, and if something goes wrong, there's insurance to protect you. The system feels solid, visible, accountable. But what if I told you there's another banking system, one just as large, operating right alongside the one you know? A system that holds your money, makes loans and takes risks, but exists almost entirely outside the rules. A system so opaque that even the regulators admit they can barely see it. This is shadow banking. And it's not some fringe operation. As of 2023, it controls roughly $250 trillion in assets. That's nearly half of all financial assets on the planet. To put that in perspective, the entire global economy, everything produced by every country in 1 year, totals around $100 trillion. Shadow banking is more than twice that size. It's grown faster than traditional banking for over a decade, and when it breaks, it doesn't send warning letters. It freezes overnight. Let's start with what shadow banking actually is. The term itself was coined in 2007 by an economist named Paul McCulley at a financial conference in Jackson Hole, Wyoming. He used it to describe a vast network of financial institutions that act like banks, lend like banks, take deposits like banks, but operate outside the regulatory framework that governs actual banks. Think of it as banking's unregulated twin. Hedge funds, money market funds, private equity firms, insurance companies lending money, repurchase agreement markets. These entities don't have banking licenses. They don't fall under the Federal Reserve's supervision. They can't borrow from the central bank in emergencies. And crucially, they have no deposit insurance protecting the people who trust them with cash. At its core, shadow banking does the same thing traditional banks do. It takes short-term money from investors and lends it out long-term to borrowers. This is called maturity transformation. A regular bank takes your checking account deposit, which you could withdraw tomorrow, and uses it to fund a 30-year mortgage. Shadow banks do the same thing, just without the safeguards. A money market fund might take cash from a corporation that needs it back in a week and use that cash to buy commercial paper or mortgage-backed securities that won't mature for months or years. As long as confidence holds, the system hums along. But confidence is fragile, and when it cracks, everything stops. The size of this system is staggering. In 2007, just before the financial crisis, shadow banking in the United States alone was worth around $25 trillion. Globally, it exceeded $50 trillion. Then, the crisis hit, and for a brief moment, the system shrank. But it didn't disappear. By 2011, it had grown back to $51 trillion. By 2022, the Financial Stability Board estimated shadow banking held about $63 trillion in assets across major jurisdictions, representing 78% of global GDP. That's up from $28 trillion and 68% of GDP in 2009. The latest data from 2023 shows the sector has ballooned to $250 trillion, growing at 8.5% annually, while traditional banking grows at just 3.3%. It's not slowing down, it's accelerating. Why does shadow banking exist? Partly because it's useful. It provides credit when traditional banks can't or won't. After the 2008 crisis, regulators imposed stricter capital requirements on banks, making it harder for them to lend to riskier borrowers. Shadow banks stepped in to fill that gap. They offer speed, flexibility, and fewer questions. If you're a company with shaky credit or a startup without collateral, shadow banks might be your only option. For investors, shadow banks promise higher returns than traditional savings accounts. After central banks slashed interest rates to near zero following the crisis, savers and institutions went hunting for yield. Shadow banking offered it. But that flexibility comes with a cost. No regulation means no transparency. When a traditional bank lends money, regulators know about it. They require the bank to hold capital reserves in case the loan goes bad. They stress test the bank's balance sheet. They monitor leverage ratios. Shadow banks face none of this. A hedge fund can borrow 10 times its capital to buy assets. A private equity firm can lever up a company it acquires with debt and walk away if it fails. And because these entities operate across borders and through complex legal structures, Even the regulators tasked with monitoring financial stability admit they don't have complete data. In a 2023 report, the International Monetary Fund acknowledged that roughly half of shadow banking funding sources remain unaccounted for. It's a black hole in the financial system. The danger isn't just opacity, it's interconnection. Shadow banks don't exist in isolation. They're woven into the fabric of the traditional banking system. Regular banks lend to shadow banks. Shadow banks lend to regular banks. They trade the same assets, use the same counterparties, and rely on the same funding markets. When one part fails, the contagion spreads instantly. And unlike traditional banks, which have deposit insurance and access to emergency central bank funding, shadow banks are on their own. When confidence breaks, there's no safety net. We learned this the hard way in 2008. The financial crisis is often remembered as a housing crash or a subprime mortgage meltdown. But at its core, it was a shadow banking crisis. Specifically, it was a crisis in the repo market. Repo, short for repurchase agreement, is one of shadow banking's key mechanisms. Here's how it works. An investment bank owns a bond worth $105. It needs cash quickly, so it sells that bond to a money market fund for $100, with an agreement to buy it back a week later for $100 plus interest. The bond serves as collateral. The transaction looks like a sale, but it functions like a short-term loan. Repo markets are enormous. Before the crisis, investment banks like Lehman Brothers were borrowing hundreds of billions of dollars daily through repo. The system worked beautifully until it didn't. In 2007, as subprime mortgages started defaulting, the value of mortgage-backed securities began to fall. Suddenly, lenders in the repo market grew nervous. If a borrower couldn't repay, the collateral backing the loan might be worthless, so lenders demanded bigger haircuts. Instead of lending $100 against a bond worth $105, they'd only lend $90, then $80. Then they stopped lending altogether. This was the run on repo. Just like depositors running to withdraw cash from a failing bank, repo lenders pulled their money out of shadow banks. And because these institutions depended on rolling over billions in overnight funding, the liquidity dried up instantly. Lehman Brothers was the most spectacular victim. For over a century and a half, Lehman had been one of Wall Street's giants. By 2008, it held $639 billion in assets and employed tens of thousands of people worldwide. But Lehman had made a catastrophic bet on real estate. During the housing boom, it acquired mortgage lenders and loaded up on subprime loans and mortgage-backed securities. When the market turned, those assets became toxic. Lehman's leverage ratio, the amount it borrowed relative to its equity, hit 30-1. For every dollar it owed 30. That kind of leverage works when asset prices rise. When they fall, it's lethal. Desperate to hide its deteriorating balance sheet, Lehman turned to an accounting trick called Repo 105. At the end of each quarter, just before publishing financial statements, Lehman would temporarily move $50 billion in bad assets off its books using repo transactions. It would sell the assets, use the cash to pay down debt, report a healthier-looking balance sheet to investors, and then quietly borrow the money back a week later to repurchase the same assets. The leverage would spike right back up, but by then, the quarterly report was published. The maneuver was material, deceptive, and undisclosed. Lehman's auditors signed off on it. Regulators didn't catch it. Investors believed the numbers. Then, in September 2008, the facade collapsed. Lehman's stock plummeted. Counterparties refused to lend. J.P. Morgan Chase, which cleared Lehman's trades, demanded more collateral. Rating agencies downgraded Lehman's debt. On September 15th, Lehman filed for bankruptcy. It was the largest corporate failure in American history. The Dow Jones dropped 4.5% in a single day. Money market funds, which had invested heavily in Lehman's commercial paper, saw mass withdrawals. One fund, Reserve Primary, broke the buck, meaning its net asset value fell below $1 per share, something that was supposed to be impossible. Panic spread globally. Credit markets froze. Banks stopped lending to each other. The entire financial system teetered on the edge of collapse. What made Lehman's failure so catastrophic wasn't just its size. It was the message it sent. For months, the government had rescued failing institutions. It bailed out Bear Stearns in March. It backstopped Fannie Mae and Freddie Mac. But with Lehman, regulators drew a line. They let it fail. The decision shocked the market. If Lehman could go under, anyone could. The implicit guarantee that major financial institutions were too big to fail evaporated. That uncertainty triggered the liquidity crisis that followed. Within weeks, the government reversed course, bailing out AIG and pumping trillions into the financial system. But the damage was done. The crisis exposed shadow banking's core vulnerability. It's built on trust, and trust is binary. When investors believe the system is safe, they lend freely. When doubt creeps in, they pull everything at once. There's no gradual decline. It's a cliff. And because shadow banks lack the backstops that traditional banks enjoy, deposit insurance, central bank liquidity, regulatory oversight, they can't weather a run. They collapse in days. 15 years later, the shadow banking system is larger than ever. After the crisis, regulators promised reform. The Dodd-Frank Act in the United States established new oversight. The Financial Stability Board coordinated international efforts to monitor non-bank financial institutions. Money market funds were required to adopt floating net asset values instead of the stable $1 that had masked risk. But the fundamental structure didn't change. Shadow banking adapted, evolved, and kept growing. Today, the risks are different but just as real. In 2021, a hedge fund called Archegos Capital Management imploded, causing $10 billion in losses across major banks. Archegos had used leverage to build massive positions in a handful of stocks. When those stocks fell, the fund couldn't meet margin calls. Its prime brokers, including Credit Suisse, were left holding worthless collateral. Credit Suisse alone lost $5.5 billion. The episode revealed how opaque and interconnected shadow banking had become. Regulators didn't know Archegos existed until it blew up. The fund operated through total return swaps, derivative contracts that allowed it to control billions in stocks without actually owning them. It was leverage on top of leverage, hidden in plain sight. In 2023, Silicon Valley Bank and Signature Bank collapsed in rapid succession, marking the second and third largest bank failures in U.S. history. While these were technically regulated banks, their failures highlighted the same fragility that defines shadow banking. Both relied heavily on uninsured deposits and were vulnerable to sudden runs. Their collapses triggered panic in money markets and forced emergency interventions. The pattern was familiar. Confidence broke, liquidity vanished, the system froze. European regulators are sounding alarms. In July 2024, Elizabeth McCall, a member of the European Central Bank's Supervisory Board, warned that shadow banking growth was, quote, remarkable and posed the biggest threat to financial stability in the Eurozone. She pointed to the opaque links between shadow banks and traditional banks through repo markets, credit lines, and derivatives. The Financial Stability Board's latest report shows shadow banking assets hit $70 trillion by the end of 2023, the highest level ever recorded. Leverage indicators remain elevated. Liquidity transformation in fixed income funds is high, and the data gaps persist. Regulators can see the outline of the system, but not its interior. Perhaps most alarming is the growing entanglement between traditional banks and shadow banks. U.S. banks now have over $1 trillion in loans outstanding to non-bank financial institutions. Major banks are partnering with private credit firms to launch multi-billion-dollar lending vehicles. Citigroup and Wells Fargo have both announced partnerships with alternative investment managers. J.P. Morgan's president admitted in 2024 that the bank needed to embrace private credit markets because they couldn't afford to ignore them. But as Michael Hsu, acting head of the Office of the Comptroller of the Currency, warned, this pushes banks into lower-quality, higher-risk loans. The boundaries between regulated and unregulated finance are blurring. When shadow banks take losses, traditional banks increasingly bear the cost. The shadow banking system now manages the savings of billions of people. It finances corporations, funds infrastructure, and provides liquidity to global markets. It's not inherently evil, but it's fragile by design. It operates on the assumption that funding will always be available, that confidence will hold, that risks are manageable. These assumptions work until they don't. And when they fail, there's no time to react. The speed of modern markets means a crisis that once unfolded over weeks now happens in hours. History doesn't repeat, but it echoes. The same dynamics that caused the 2008 crisis, excessive leverage, opacity, interconnection, reliance on short-term funding, exist today, just in different forms. Regulators know this. The Financial Stability Board monitors it. Central banks issue warnings. But the political will to impose stricter regulation on shadow banking has been limited. The industry argues it provides essential services. It fills gaps left by regulated banks. And it's true. But those services come with systemic risk that when it materializes doesn't stay contained within hedge funds or money market funds. It spreads to the entire financial system. The question isn't whether shadow banking will face another crisis. It's when. Markets move in cycles, confidence builds, leverage grows, risks accumulate, and eventually something breaks. A default, a failed auction, a sudden loss of liquidity. The trigger doesn't need to be catastrophic, it just needs to be enough to crack confidence. And once that crack appears, the system doesn't bend, it shatters. So what can be done? Transparency would help. If regulators had real-time data on shadow banking exposures, leverage, and funding sources, they could spot risks earlier. But collecting that data is difficult when entities operate across borders and through complex legal structures. Capital requirements could be extended to non-bank lenders, forcing them to hold buffers against losses. But that would reduce their flexibility, which is precisely what makes them attractive. Central banks could expand access to emergency liquidity for shadow banks, but that would create moral hazard, encouraging even riskier behavior. The truth is, there's no easy fix. Shadow banking exists because it's profitable and because it serves a function. Restricting it too much pushes activity further into the shadows, leaving it unregulated, courts disaster. The balance is delicate, and right now, the scales are tipping toward risk. If you've followed this far, take a moment and think about where your money sits. Is it in a traditional bank with deposit insurance? Or is it in a money market fund chasing higher yield? Do you know who holds your retirement account? What assets back your insurance policy? Most people don't, and that's by design. The shadow banking system thrives on complexity. It assumes you won't ask questions, that you'll trust the numbers on the page. But the ghost of 2008 lingers. Lehman Brothers was 164 years old when it collapsed over a weekend. Bear Stearns was 85. These weren't fly-by-night operations. They were pillars of Wall Street, staffed by the smartest minds in finance, audited by the top firms, and trusted by millions. Yet they vanished in days because the system they relied on, the shadow banking system, had no foundation. It was built on borrowed confidence, and when that confidence broke, there was nothing left. So ask yourself, if a crisis hit tomorrow, would you see it coming? Or would you wake up to frozen accounts, failed funds, and a market in freefall? The shadow banking empire operates in the dark. It doesn't announce its vulnerabilities. It doesn't send warnings. It just stops. And by the time you notice, it's already too late. If this made you think differently about where the real risks hide in our financial system, let me know in the comments. And if you want more stories that pull back the curtain on how money and power actually work, hit that like button and subscribe. Because the next collapse won't look like the last one. It'll be faster, bigger, and harder to see until it's already here.